One of the things as an investor you really need to avoid is that parts of your portfolio just get wiped out. And what I mean by wiped out is that you have a loss on your portfolio which is irrecoverable. Now, it's really important to distinguish between a loss on your portfolio which is irrecoverable and a mark-to-market loss. Now, a mark-to-market loss is where you've invested, let's say, either in an ETF in a financial market or maybe in a share. It's not been a great decision. The price has gone down, but you can have reasonable confidence that over time the share price will come back, and therefore it's essentially a paper loss. Now, of course, that's not desirable. None of us want to lose money, but at least you know you've still got the assets and you expect it to come back over time. A wipeout loss is something quite different. A wipeout loss is where, for example, you've bought a share and the company goes bankrupt. The share is then worthless and that money will never ever be coming back. Another example is where you've invested in a scheme which you thought was good and robust, but due to fraud or because it was a scam, you've lost money to the fraudster. You may never see those funds again. These wipeout losses must be avoided at all costs because they seriously impair your returns over the longer term. And of course, you feel very foolish when you've lost money that way, but simply because the money is never going to be coming back again. Let's now have a look at how some of these wipeout losses might occur, and specifically, let's also look at some of the measures that you can take which will firstly mitigate the risk of you incurring such a wipeout loss, and also how you can reduce the longer term impacts on your portfolio. I spent 30 years in the markets and I've seen this happen so many times. So let me share with you some of my experience as to how these matters can best be dealt with. Now, I'm going to divide this presentation into 4 sections. The first one is intended at those people who are buying small companies, either the equity of small companies or possibly debt issued by small companies. The second is for large companies, those who are buying equity or debt again in large companies. This really is the majority of investors will be owning this type of financial asset. The third area I want to cover is sovereign risk. If you're buying bonds issued by sovereigns, clearly there's no shares issued by sovereigns, but if you're buying bonds issued by sovereigns, are you at risk of wipeout risk, and where does that risk likely sit? And then the last area is fraudsters, scams, illegal schemes, measures you can take to avoid falling prey to any of these. So let's now have a look at the first one, small companies. So often, many of us choose to buy small companies in our portfolios. There are often tax incentives to do this, or sometimes our employer perhaps maybe requires us to own a stake in the company. Now, small companies are especially exposed to wipeout risk. Now, the reason why that is because small companies obviously are more prone to struggle in economic downturns. They may also be highly leveraged. They don't have a number of different business lines where one of them might be in trouble, but the other business lines will carry the company through. Or another area where small companies are particularly vulnerable is they often have small management teams, and one person in that management team, they leave, they get ill, and that is such a serious loss it drags the company down. As a result, my experience of investing in small companies, that many of those, even with the best idea, the best implementation, sometimes do go bankrupt. It's just a sad fact of life for small companies that the probability of them making it through the next few years is going to be lower than it is for large companies. So what can we do to mitigate the risk when we know we're buying these stocks, but we know the probability of them going bankrupt is that much higher? Now, clearly, you can do a lot of due diligence on the companies you might buy, and certainly my advice would be, unless you are competent to be doing that, make sure that you have an asset manager or a specialist who is doing it on your behalf. This is a very technical area, it's extremely time consuming, and therefore the due diligence into the competence of a company is not, in my opinion, something any one of us who does not have those skills should be engaged in. So do take care. Don't be tempted to go rush in and buy something because you have a tip from a friend, unless that friend has those skills and is able to dispassionately analyse the company. Now, even then, a sensibly analysed company may still, for whatever circumstances, go bust because the management team doesn't hold together. There are just so many things which can drive one of these companies under. So 2 things you need to consider as well. First, how many small companies do you hold in your portfolio? And I think the key here is diversification. Make sure you have a diversified portfolio. Don't put a huge amount of eggs into one basket. So in other words, try and make sure you own small stakes in a large number of companies. For those that pay off, the returns can be enormous, but at least you're not exposed to a very small sample, let's say 1 or 2, and if 1 or 2 go wrong, you've lost everything. So strategy number 1, diversify. Only you can decide how many companies it's right for you to buy, but I do strongly encourage diversification. The second strategy is to consider how many small companies should be in your allocation. In other words, if you decided to put 60% of your portfolio into very small startup companies, this is a risky portfolio. If you put 10% in, clearly that's a much smaller risk. You need to take a view on what is right for you, but certainly look at the worst case scenarios and how comfortable you would feel if there was to be a serious recession and 50 or 60% of your portfolio is wiped out. In other words, stress test it in your mind. Think about the worst case scenarios and then take a view on how big a percentage your overall allocation to small companies should be. A third strategy you could consider is that since small companies are particularly vulnerable to recessions, to make sure that you own some government bonds which will perform better in the event of a downturn. That's a kind of partial hedge, but remember, it's only a hedge against the downturn in the economy. It's not really a hedge about bad management, change in politics, or many of the other circumstances that can drive one of these companies under. But at least it may be worth considering. So those are the 3 strategies you consider to reduce the risk if you have a portfolio of small companies. Now, investing in large companies is a totally different experience. If you're buying publicly traded equity of companies on the S&P 500, the NASDAQ, the FTSE, the CAC, the DAX, whatever, these are much larger, often much better established companies with a multitude of business lines, and the likelihood of them going bust in the way a small company does is that much lower. That said, there are a couple of warnings for you. The first is that there are cases of large companies, and I can think of one with a AAA credit rating, which has suddenly gone into default and gone bankrupt. It has happened in the past. It is extremely rare, fortunately, but do bear in mind that you can have sudden losses like that. Now, a more likely eventuality is that a share price previously of $100, something badly affects the company and it goes suddenly down to $30 or $40. Great, you still own the shares, but don't kid yourself, it's necessarily the case that that share price will go back to $100. Treat it like a new investment. Think carefully, will I ever see my money back? And again, look at worst case scenarios. Once you've considered those, it'll probably lead you to the same conclusion as you drew with smaller companies, that diversity is key. To have a very, very small number of holdings does leave you exposed to a big loss in one of those holdings. So you need to consider how much you're willing to allocate to any one share and how many line items, in other words, individual stocks or bonds, you have in your portfolio. Clearly, if you invest in ETFs, this is a much easier strategy because they often hold a large number of shares or bonds, and that gives you some diversity anyway, although do bear in mind many ETFs have a concentration in a few very large names. So you can find that maybe 30% of your ETF is in one single stock. Now there's a couple of other things to watch for here. One thing to watch out for is that if you're buying a company, let's say the stock in a company where it has a lot of assets, you do know that in a worst case scenario, the shareholders will have some recourse to those assets, especially if those assets are readily marketable. Infrastructure companies are a very good example of that. This will give you some comfort that if that company does go bust, the shares will have some residual value. You don't really want to go down that road, but at least it might give you that comfort. Second thing to consider is how much has the company borrowed. If you're buying a company which is heavily indebted, chances are the bondholders will take all the assets and there'll be nothing left for equity holders. So you need to consider, am I going to be a bondholder or am I going to be an equity holder? Or where was I sit if this company goes bust? Again, that's a lot of work to undertake. And if you feel as though that's not something you want to do, either A, diversify, B, buy ETFs, or C, get someone else to manage your money. I think it's a huge amount of work to actually look into the balance sheet of every company on your portfolio and decide how much will I be left with if this company suddenly goes into default. Another thing you want to watch out for is that a lot of companies do not suddenly go bankrupt. They go bankrupt very, very slowly, and the share price gradually goes down and down and down. A lot of investors just don't notice this because it's a sort of creep. Every day down $2, up $1, down another $2, up $1. And over a period of a year, 2 years, the company has underperformed terribly. How can you mitigate against that risk? Watch what's in your portfolio. Reevaluate everything that's in your portfolio. Make sure your monitoring standards are what they should be. It is so easy to say, I've got all these stocks in my portfolio or all these bonds, I'm not monitoring it, it's all okay. And what you haven't noticed is that one stock is bleeding away and it's going to go down and down and down, it's never going to come back. We could all think of companies which were once great household names, which didn't suddenly go bankrupt, but they got into a terrible situation over a period of 1 year, 3 years, 5 years, because the industry changed and they didn't keep pace. So if you own the stock or bonds in a company, make sure you're watching that share price and make sure you have a view on its future. Don't let sudden losses like that sort of grill away at you day by day suddenly leap up at you by surprise. You haven't looked at it for 6 months and you've just lost 50%. That is to be avoided. And the last thing I wanted to highlight about large companies is that you can divide them into 2 categories. Category 1 are the non-financial companies. For example, IT companies or pharmaceutical companies. And category 2 are the financials, and in particular the banks. The reason why I split banks away from the non-financial companies is because when banks go bust, they go bust very, very quickly. Sometimes the regulator gets involved to ensure there's a bailout, and often the reason why the regulator gets involved is precisely because that reason. They go bust really, really quickly, and you will have no time to sell your shares. So when you're owning bank shares, and to an extent this could be true of insurance companies, watch very, very carefully to make sure you know what you own. Because whereas companies in some industries can drift lower, as we discussed earlier, a company like a bank overnight can be gone. We can all think of the news headlines of banks which have suddenly disappeared. So I think therefore when you're investing in large companies, look carefully what you own. Think about whether it's a financial or it's a non-financial, and make sure that you have the information systems in place to A, understand your holding, B, make sure you know the price of that holding and you can see how it's trading over time, and C, make sure you've got the right diversity there. Don't stick all your eggs in one basket. So having discussed the corporate world, where it's all about corporate stocks or maybe corporate bonds, let's now have a look at the sovereign world, where sovereigns borrow in the bond market. Now, in order to understand your likelihood of loss, we've got to look in more detail at some of who these sovereign borrowers are. So let's categorise them. So one category is countries like the United States. Borrows heavily in the bond market. Clearly in the United States there is this issue of the debt ceiling, where Congress does not get around to approving an increase in the amount of bond issuance, and that could cause some kind of temporary default. But one can have some comfort with the United States that firstly the government has other means of financing itself. It's a very large government as well, and it has significant tax raising powers. It's also borrowing in its own currency, it's borrowing in US dollars. And lastly, there's always the possibility the central bank may buy government debt. So many might feel that the likelihood of a long-term US default is quite low, and therefore structurally you might feel safe investing in that type of borrower. The second category is other developed nations, where the number of investors who buy their bonds is not quite as elaborate as in the US Treasury market. In the US Treasury market, because the dollar is a reserve currency, you have investors from Japan, from Europe, of course from the United States, all over the world involving themselves in that market. So in some ways, it's quite hard to conceive of financial stability if the US government did not pay its bills on treasuries. For other developed markets, however, although many of those positive attributes that I've highlighted also apply to them, they're not reserve currencies, and they may not have the institutional backing of such a wide variety of investors. Now, the next category is bonds issued by emerging markets, in other words, outside the developed world. Now here the risks of wipeout are much, much greater. And there's a variety of reasons why this can happen. Reason number one is political instability. The country has a new regime and it decides it's just not going to pay its debts. Reason number two is emerging markets often have much more volatile economies than the developed world, and therefore their ability to pay their debts from an economic point of view can suddenly diminish. Reason number three is much more technical, but is very important to understand. An emerging market may borrow in its own currency, but often the market is so small in its own currency, it decides to borrow in someone else's currency. In other words, it issues bonds which are denominated in dollars or in yen or in euro or sterling. This is very, very tricky, because if a country issues bonds, let's say issued in dollars, it needs to get those dollars from some way to pay the investors. So it's always dependent upon its balance of payments. In other words, if it's exporting to the rest of the world, it gets the dollars in from its exports and it can use them to pay the interest on its debt. What happens if its exports fall out of demand or there's a global recession? It ceases to get the dollars coming in and therefore it can't pay the interest on its own debt. If it had borrowed in its own currency, it could print money and pay the interest on the debt. It doesn't have that dependency upon its balance of payments. But if it borrows in someone else's currency, then it has that dependency. So often what you notice is that emerging markets economies, they've borrowed in someone else's currency and they run that higher degree of default. How can you mitigate the risk? First, it's important to acknowledge that the risk of default is probably going to be higher for these emerging markets bonds. And you can see that because the credit rating agencies publish credit ratings for them. And it's important for you to look and see what the rating agencies have assigned to the debt of these currencies. And then having looked at that credit rating, have a look at the default probability. If it's single A, obviously the default probability is quite low. If it's something like single B, then clearly it's going to be very much higher. You have to take a view as to what your appetite for risk is. But again, my advice is going to be the same as with small companies. Diversify. Don't put all your eggs in one basket and just buy bonds issued by one particular country because the yield is so attractive or you think you know about that one country. Firstly, your knowledge may not be as complete as you thought. And secondly, there is always the risk of political change. It happens very suddenly and you hadn't anticipated that. So if you are buying sovereign bonds, particularly outside the developed world, look on them with extreme caution. Look at what the rating agencies are putting out in terms of credit ratings and manage that diversification very, very well. Otherwise, you could find a portion of your portfolio suddenly gets wiped out. Now, the last thing I wanted to highlight concerns fraud and scams. It is so tempting when someone who looks credible comes to you with an investment proposition that guarantees outsized returns you would not normally expect to see. In particular, returns you would not expect to see given the level of risk they are trying to persuade you that you're taking. It is very easy to fall prey to this. So a lot depends upon the country that you live in, but most countries have some kind of regime to compensate you if things go wrong. But a few highlights here just to think about. First, your level of compensation if things go wrong and this proves to be a scam or a fraud may not be 100% of your initial outlay. So think carefully before you invest and have a look to see what would happen if it did prove to be a scam. Second thing to consider, again, depends upon the country you live in, but my experience is regulators are extremely helpful. If something looks too good to be true, check it out with a regulator. Check it out with your accountant. Check it out with a third party. And if in doubt, report it to the regulator. Think very, very carefully about what it is you're buying. And if you don't think it smells right, get on the phone to the regulator and give them the details. So those are 4 ways that people, from my experience, I've seen lose money and where those losses are never going to be recovered. You don't want to be in those situations, and therefore make sure you have the right processes in place when you build your portfolio to mitigate the risks and ensure if it does happen, and occasionally it might, it's a very, very small loss that you experience as a proportion of your total portfolio. I really hope that this video has been useful. I appreciate it's not the type of thing we like discussing. Normally we like looking at returns and how we're going to make money, but I do think on this occasion it's worthwhile covering how we don't lose money. But I hope you found it useful. If it is, please tick like, please tick subscribe so other people can find out more about this video, and there'll be more videos coming along in due course. In the meantime, happy investing, but do make sure you stay safe out there.